Happy New Year and welcome to a new edition of a chat with Daman Asset Management team. In this edition, we will be highlighting our investment outlook for the year 2022.
Following the surprise in 2021 with a strong inflation, we are somehow less worried about it in 2022, but we still think it will settle at an elevated level, and consequently, we are bullish on countries with strong external accounts or where inflation may appear to be more easily contained. We are more cautious on growth as well over the year. Having said that, we still prefer high yield versus investment grade with the lower tier in the BBB bucket, while being cognizant of the tail risk within this segment. As always, bottom-up analysis will be the key differentiation. At a policy level, we see the Fed hiking once or twice eventually this year, which is much less than what is priced by the market currently. In fact, we expect the US curve to keep its 2021 flattening trend despite obviously some steepening episodes as we currently see. And the narrative should shift eventually from bear flattening to the curve to bull flattening, and as a result in fact of the subdued growth and the elevated inflation. Our bias is still tactically to manage high yield component with bottom-up differentiation and credit selection, while the macro call and the duration exposure will ride on the back of the Fed policy developments. How do we translate this view? This is actually by taking calls like, for example, in Asia, we completely underweight Sri Lanka and we market weight Pakistan. For the MENA, we like Oman and Egypt, where we are market weight. In Africa, we think Ivory Coast and Cameroon are actually good overweight, while what's happening in Ethiopia, we give it an underweight. In Eastern Europe, we obviously underweight Turkey given the unorthodox monetary policy and the lack of fundamentals, while we still market weight in Ukraine and Romania despite the recent event. For Latin America, we overweight Colombia and Panama, while in fact, unfortunately, given the recent political developments, we underweight Peru and Chile.
Global equities returned 17% in 2021, and we expect 2022 to be another positive year with a potential return of 10% on a continued rebound in global economy, supporting earnings growth. We expect these returns to be driven by earnings growth of 10% in 2022, which will slow down from 2021 levels of 49%, while one-year forward P multiple holding at the current levels. We do not expect a multiple contraction in 2021, as any rate hikes would be offset by compression in equity risk premium on investors looking for a positive real return. We expect volatility to increase in first half of 2022 on a tightening monetary and fiscal policy conditions and moderation in earnings and economic growth in 2022 versus 2021. Given our expectations of limited impact from Omicron, above-trend global economic growth in 2022, and near-term steepening in yield curve, we recommend a value and cyclical tilt and are overweight financials, energy, and industrial sectors. We also see value in reopening sectors such as airlines, travel, booking, cruise lines as Omicron wave subsides, vaccination rates improve further, and consumer spending shift to services from goods. Given our expectation of a heightened volatility, we recommend a well-researched bottom-up stock picking approach to identify companies which can navigate supply chain issues. We prefer DM over EM, as EM central banks remain under pressure to respond to rising US yield, expected rate hikes in US, higher inflation, and increased downward pressure on currencies. In EM, we are overweight Asia and MENA and underweight LATAM and Europe. Within EM Asia, we prefer China, South Korea, Indonesia, Malaysia, and Thailand. We like an exposure to Saudi, UAE, Qatar, and Egypt in the MENA region, and Mexico in LATAM. Within commodities, we stay bullish on oil price with year-end target of $90 per barrel on rebound in demand tied to further economic reopening and supply remaining tight driven by significant underinvestment in capacity over the last 5 years. On the other hand, OECD oil inventory is also significantly below the last 5-year average. We are constructive on aluminium as the supply remains tight and demand will be driven by decarbonization and rebound in production of automobiles as supply chain issues get resolved. Within MENA equities, we are constructive on Saudi, UAE and Qatar in the GCC, supported by a continued strength in oil prices and high vaccination rates, increasing contribution of the non-oil GDP as the governments push to foster industrialization and digitization. Also, there is a strong inclination towards listing key GREs and encouraging private companies to list to reflect economic wealth on capital markets. In Saudi, Vision 2030 act as a major structural driver of the economy, earnings and stock market. Tadawul's 1-year forward PE multiple of 18x is backed by a strong average expected EPS growth of 15% over the next 2 years. The UAE has announced its 10-year industrial strategy, and Dubai has announced plan to list 10 state-owned firms. Dubai trades at an attractive valuation with a 30% discount to the MENA region on a 1-year forward PE basis. Qatar's $28 billion LNG capacity expansion plan, FOL increases and markets underperformance in 2021 versus the region set the stage for a strong performance in 2022. We also like Egypt as the market trades at a 50% discount to the MENA region, and we expect the country's FX reserves being at healthy levels and recovering tourism to support currency. Increasing FDI from the GCC region and a strong pipeline of upcoming IPOs would lead to a spillover of liquidity from the other regional markets.
In this edition, we will be highlighting our investment outlook for the year 2022. Thank you for taking the time and watching another edition of A Chat with Daman Asset Management Team. You can always contact us on our website and social media platforms. Till the next edition.